Hey everybody, today is April 4th, 2023, and today we're gonna talk about the stock market and where I think the stock market is headed for the remainder of the year. Are we going to potentially break out of this sideways consolidation into a new bull market, or are we going to continue down into a bear market? Before we begin, please pause this video and read the disclaimer. Okay, so first of all, I just want to apologize. I haven't made a video in a little over a year, and I just had a lot of personal things going on in my life, and I felt the need to pause and work on those things, or just handle those situations before I continue to post my analysis videos, because YouTube is really just it's just a hobby at this point, right? Part-time thing. It's not my main source of income. But yeah, I'll try to be more consistent now. So basically, where we left off a little over a year ago, we basically were seeing record inflation, right? And the Federal Reserve was trying to fight inflation by raising interest rates at a pace we haven't seen since the 1980s, right? And that basically caused the stock market to basically plunge into a bear market, basically, as the raising interest rates basically slowing the economy down. And the Federal Reserve has been trying to slow the economy down without trying to bring the economy into a recession, right? Basically what they call a soft landing. And that's it's fairly difficult to do, but so far they are basically on the tight edge right now. And they're potentially going to pull it off, but I mean, not without like potential consequences, right? And one of them is reflected in the stock market right now. We basically been going sideways for almost a year now, right? If we just go sideways for one more month until May, we basically have been going sideways for a year, this whole period, right? So if we zoom out and we look at the bigger picture, the question is, where is the market headed? And I know I have a lot of Fibonacci lines, so I'll give you a clear chart right here. So where is the market headed, right? Right now we are basically building a base of support. Here, this is the S&P 500. If we are to break out of this support level, we're just going sideways. We're in a ranging market. We've been trying to break out of this resistance level, right? And so far we're forming pretty good price action. You know, you can call this potentially an ascending triangle, right? We have higher lows, which is always good, right? That means that every time short sellers try to bring the price down, right, the supply is absorbed, and so the buyers are defending these levels. And potentially, the more we test the resistance level, the more likely we are to break above. So right now, I believe that the bulls have the advantage right now, basically. Of course, the bears can always try to bring it down and retest this support level, right? But for now, the longer we go sideways, right, the more the bulls have, the higher the chances that the market will break out higher than it will lower, right? So for right now, I'm giving the benefit of the doubt to the bulls, and I will assume as long as the bulls are able to defend at least 3,800, right? 3,800, and obviously if they take out 3,500, then we are probably going to continue down into a bear market. But for now, you can sort of look at this. If we look at the bigger picture, right, you see all these moving averages, right? Moving averages tend to act as support in the longer run. These are simple moving averages, meaning that they tend to lag rather than try to predict, right? As opposed to like exponential moving averages. So as you can see, this is over a 10 plus year period. We tend to see the price come down and test and hold these support levels in a strong bull market. And you can make the argument that during the pandemic, because we have all the stimulus checks going out, right, all this money printing, expansion of the balance sheet, and low interest rates to try to fight a possible Great Depression, part two, right? Last Great Depression was in the 1930s. You can make an argument that what we're seeing right now with this last year's 2022 bear market and current consolidation is actually quite healthy. See, all we've done is basically pull back to these moving averages, right? This is a 200-week moving average, which we basically tested and held at support here in 2020, pandemic crash, 2018, and 2016, 2015, right? So we're not seeing anything. Let's look at the monthly chart really quickly just to strengthen this idea, right? I mean, look at this. We're coming out. We haven't broken below. Well, we just dipped our head below, but we closed above the 50-month moving average, right? So what we're seeing is we're still in a secular bull market, meaning that the overall trend, this is the monthly chart, right? The overall trend is still on the upside, even though we had a bear market last year. So I think it's too early to say. There's still a lot of people who believe that a recession is coming, and we'll talk about that later. A recession is coming, and the market will potentially go down lower and plunge into a bear market, like we saw in 2022. Let's go back to SPY, the ETF that tracks the S&P 500, right? And just to give you another example, right now we're seeing a battle between the bulls and the bears, trying to hold this Fibonacci. We've basically been going sideways in this Fibonacci channel, right? The 0.618 and the 0.786 Fibonacci channel. For if this thing continues to stay in this channel by May, it will have been in this channel for a year, basically, right? So, but that's not necessarily a bad thing. Like I just said, the longer the price goes sideways, the more bullish it is, because it just means that the bears are having a hard time bringing the price down, and the bulls are absorbing any selling, right? And that's going to give more more incentive for people to take more risky bets as they go long, potentially using leverage to push the price higher, right? And so speaking of traders, let's look at what the sentiment is, right? We spent some time in fear, especially with the regional bank crisis that we had in early March, right? With banks liquidity like drying up, people pulling their money out, and run on the banks, potential banking crisis, at least on a regional scale. But now the market is starting to recover from that, and we're starting to move towards neutral, right? And even though I believe the market will continue to eventually break out of what I just said, this basically just year-long consolidation, right? I believe we'll eventually break out and go to the upside. I do think, at least in the short term, we'll probably pull back. Why? Because look at this. We've basically gone up almost like we had a pullback today, but we basically had like a gap up in 4 consecutive green days, right? And if we look at the shorter time frames, we're starting to see that our oscillators down here are showing that we're overbought. So I can see this pulling back, maybe filling 1 or 2 gaps before pushing up higher. So that's what I believe is going to happen in the short term. But let's look at let's go back to what I think is going to happen for long term, right? Because this video is about what I think is going to happen for the remainder of the year. So of course, the main narrative over the last year and a half has been the Fed, right? Are they going to keep raising interest rates? Because that's really been the main catalyst that's been pushing the price down. That's been putting downward pressure on the stock market, right? So right now the Fed funds rate is 4.65. Some people are calling for a pause or even a cut, but I actually think that in the next meeting they might raise the rate another 25 basis point, and they might even do another 25 basis point after that. But I do think that the terminal rate is going to be just over 5%, and so that's probably going to be 2 25 basis point hikes over the next 2 meetings. But really, a lot of it is going to depend on what the CPI report is, right? If inflation is higher than expected, obviously they're going to probably be more aggressive with not only the amount they raise, but also the speed at which they raise it at, right? But I do think that with the regional banking crisis that happened early March, the Fed is basically being a little bit more cautious. They're probably not going to be as aggressive, right? Because they don't want to, of course, their main goal is to fight inflation without causing a recession, right? A soft landing again. Very difficult to achieve, but if they're able to pull it off, it's going to be quite incredible, right? But obviously, we as investors have to try to predict what's going to happen. So that's just my own belief, is that 2 25 basis points is probably likely, unless we get like just amazing CPI reports that inflation is just plunging, right? Then they might pause. But I really don't see the Fed cutting until at least 2024. I could be wrong, but that's just my own prediction. Now let's look at the balance sheet. Right? We saw a huge spike in the balance sheets after the regional bank crisis in early March, and a lot of people are saying that, okay, now that the Fed is increasing their balance sheets again, are they going to stop tightening potentially? Are they going to start potentially pausing? So this could be another I guess catalyst for people's beliefs that the Fed might not be as aggressive in their or as dovish as people believe they will be. And let's look at the 2 and 10 years Treasury, the inverted yield curve, right? The yield curve has been inverted since July of 2022, right? This is a fairly long time. We compare to the past. The last time we had not only this much of a decline, but just also the length of time it's been inverted, the yield curve, right? It's been in the 1980s. Like we just said, the rate at which the Federal Reserve is raising interest rates is the fastest we've seen since the 1980s, right? So potentially we can look at the 1980s price action to give us an idea. And as you probably know, in the 1980s, at least in the beginning, from 1980 to 1982, where basically the market wasn't doing so. The market wasn't doing so well, right? It wasn't until 1982 that we had this start of this incredible bull market. Let me show you. The start of this incredible bull market, which peaked in the 2020 in 2020. Sorry, not 2020. In 2000, with the 1990s tech bubble, right? That famously collapsed in 2000, right? So from 1982. So you see how in 1980 to 1981, we basically were just sideways, right? But from 1982, right, it just this incredible bull market all the way up 20 years or 18 years, right, basically. Let me just reset this chart. Yeah, so personally, I do think that what we're seeing right now, just to summarize, what we're seeing right now is the market. I'm just getting a clean chart. Sorry, it's lagging a little bit. Let's get a weekly chart, right? So what we saw last year was basically the market resetting a little bit, right? Like we discussed earlier in this video. It's healthy for the market to pull back and to retest these moving averages, right? This is a 200-week moving average. And I believe that's what we're seeing right now. In 2021, we saw an incredible rise. But this rise was so steep that it was a bit unsustainable, right? And so it's healthy for the market to pull back. So in 2022, we saw a market pullback to the 200-week moving average. And we defended this level around October. And now we're basically going sideways. And like I said, the longer the market goes sideways, that's actually in the bull's favor, right? Because that means the bears are having a hard time pushing the price down. And now, again, we are moving towards the resistance level, the upper boundary of this range, right? Which, we know that the more the price tends to test a certain level, whether it's resistance or support, the more likely it is to break through. So I believe that if we keep testing the resistance level, right, eventually we'll break through and we'll move higher than this local swing high over here back in August, right? And then our next levels of resistance obviously are going to be this level around 4,500 and then 4,800, right? That's our new all-time high. And let's look at this SPY chart. And yeah, so like we just said, this local swing high that was set in August is also coincidentally also this Fibonacci resistance level. So I believe this level, and also we look at here, it's the 100-week moving average, right? Which we're also trapped between the 100 and the 200-week moving average, right? So a lot of confluence of resistance levels, meaning that this is probably gonna be a difficult level to break through. We might even do one more pullback down lower before moving up higher, right? Just completing this year-long ranging pattern, right? Again, if we are able to break through, then that's actually very bullish. That means that if we're able to break through, even though we've gone sideways for a year, it's very unlikely that the market will just plunge back lower and then continue down lower, right? Usually that doesn't happen. It's very rare to see that, unless there's like a catastrophic event that happens, right? Usually an exogenous event, right? Like the pandemic. But overall, I am bullish on the market. I do believe that we will continue to grind higher. We might go sideways for a little while, but I believe the market will head towards trying to take out the all-time high before the end of the year. I don't know if we're going to reach all-time highs by the end of the year, but I do think that we're going higher rather than lower. Of course, we have to take things into account as the new information comes to light, right? Obviously, we don't know what the CPI does. Inflation could get worse, and the Fed might be forced to raise rates, and that will definitely put some downward pressure on the stock market. So, of course, we have to. Our opinions, our beliefs on the market will change based on the information that comes out and is available, right? We can only make our decisions based on the best information that we have available. So definitely update you, and as the new events come out, and yeah, I'll try to be more consistent. Again, I apologize if I haven't posted in a while, over a year. Yeah, so that's it for this video, and next time we'll see if the market is finally able to break through to the upside and potentially try to take on this Fibonacci resistance level around 420, right? So thank you for watching this video. Please like this video, leave a comment below, and subscribe for updates. I appreciate your support. Thank you again, and have a great day.